That's all.
Different life cycle, different timeline. Cash flows 10 years. So once you Justin. Probably like most
Okay, so I'm going to start the next 4 sessions with the same 2 questions. And if you've been in my corporate finance class, you know what the questions are going to be. Here's the first one. How many of you have picked a company to value? As you can see, most of you haven't. That question will get reframed next week. The question I'm going to ask is, how many of you have not picked a company? Because I'd like the numbers to kind of shift, which is the rest of you right now. Don't wait around. Don't try to find the perfect company. There are 48,000 companies. Don't tell me you can't find a company, right? Don't look for other people to give you, just pick a damn company and get started. And if you change your mind, you can always go change the company. So if you've picked the company, the follow-up question is, have you gone into the master list and entered your company name? Please do so. Again, you're not bound by it. You can go back and change that company name if you want to. This is just for me to get a sense that you actually are doing something. So please do it for me. So after you pick a company, go in and put your name on it. Yes?
Know how to do
Nothing. So don't fill out somebody try to fill out all the rest of the cells. If you do, the rest of the class becomes moot, right? This is, at the moment, all you've done is picked a company. It's a blank slate. So the rest of that spreadsheet will get filled out over the course of the class. But no. It actually will be worse, because then you're picking the company for the wrong reasons, right? You're picking it because you want to know a segment. Knowing where you might want to work might be relevant, right? Because you might want to understand the business you're in. So if you're going to go work in pharmaceuticals, my suggestion is pick a pharmaceutical company. You're going to work in technology. So it's not what you want to learn out of this, because you will always learn from any company you pick. Pick something, but most critically, pick a company you're interested in, right? Pick something that you always wondered why. Right. Tomorrow's valuation of the week is going to be NVIDIA. You got my advance notice with the DeepSeek post, but it will be about NVIDIA. And I want you to wrestle with NVIDIA, because let's face it, it's not just we're all interested in NVIDIA, the entire market is waiting with bated breath on what will NVIDIA do. Right? So with that out of the way, let me get started with the start of the class test. As I said, every session will start with this. So let's start with today's start of the class test. It's about consistency in cash flows. Let me set the table. We haven't done this yet, but when you sit down to value a business, you have to make a choice. What is that choice? You have to decide whether you want to value just the equity in the business or value the entire business. Sounds like I'm playing on words, but let's start a business. You guys are going to be equity investors. You guys are going to be lenders. I raise money from you in the form of debt. I raise equity from you. And this can be a private company or a public company. It doesn't matter. Private company is just equity in its unnamed form. In a public company, you'll be buying shares. So I've raised 100 million from debt, 150 million from equity. I start the business. Factory, platform. Let's say the business starts working. Cash flows start to come in. Who gets first claim on the cash flows? Interest and principal payments. And if there is any cash left over, there's no guarantee there will be, I might give it back to you. Why might? Because there's no contractual requirement that I return the cash. I might pay a dividend, I might buy back stock if it's a publicly traded, or I might just hold the cash for you. Even though I forget sometimes that it's for you, I think it's for me, but it's for you. The bottom line is, as a business, I generate cash flows for both of you. In valuation, you got to make a choice early on. Are you going to focus just on the equity investors and discount the cash flows that equity investors get? So you guys are the lenders. So I'm not going to look at you. Equity investors, take the cash flows you get as leftover cash flows and discount it back at the rate of return you would demand for. Call this a cost of equity, but let's strip it down to basics. You didn't invest in my equity because you felt sorry for me, I hope. You invested because you wanted to make a return, right? 12%, 50. You know what the cost of equity is? It's that number that you had in your head. And already you can see this is going to be a nightmare to estimate. Why? Because it's in your head. Unlike the lender who puts an interest rate on the loan, this is something in your head. We'll talk about what in finance we do to kind of get around that problem. Cash flows to equity, discounted the cost of equity, is the value of equity in a business. Of course, if you're an equity investor in a publicly traded company, the only tangible cash flow you get from the company is what? Dividends. Everything else is kind of waving hands, free cash flow, I can compute on paper. Dividends are the only, it's a check in the mail or a deposit in your bank. The dividend discount model is a special case of an equity valuation model. Why special? Because we know conclusively that companies don't pay out what they can afford to in dividends. We'll talk about why we know it so conclusively. They hold back cash, they pay out too much in dividends. So we'll talk about an alternative way of estimating cash flow, which is potential dividend. For those of you in our corporate finance class, we attached an acronym to it. Do you remember what the acronym was? Let's see how much corporate finance you still remember. Michael, you remember?
I think you're referring to free cash flow to equity.
Free cash flow to equity, which is basically cash left over after you met every conceivable need, right? Cash flows to equity, discounted the cost of equity is the value of equity. But there's another way I could have approached valuation that requires a little bit of an intuitive leap. I got capital from both of you, right? Equity and lenders. What if I thought of both of you as capital providers and look at the collective cash flow you get from the business? That's going to be cash flow to equity plus the cash flows to debt. That collective cash flow is called free cash flow to the firm. It's a pre-debt cash flow because lenders are now players in this game. They're capital providers, they're not outsiders. If that is the cash flow I'm discounting, not the cash flow to equity, but the collective cash flow, I can no longer discount that cash flow at the cost of equity. I've got to discount it at some weighted average. If this is starting to sound familiar, it should. If it isn't sounding familiar, then you might have some issues with your corporate finance class. If I take the cost of equity and the cost of debt and I take a weighted average, what is, please, let's call it cost of capital. WACC sounds so crude. Let's call it cost of capital, but it's a weighted average cost of capital, basic. So if you have cash flows to the entire firm, the discount rate you should apply is the cost of capital. Consistency rule 1 in discounted cash flow valuation. You cannot mix and match. You tell me how you estimate cash flows, I'll tell you what the discount rate should be. Do you think people break this rule all the time? And people who should know better, or perhaps know nothing at all. So I'm going to, for today's class, talk about what ends up happening in practice. So I'm going to take you back all the way to the late 70s. Company called Kennecott. It's a copper mining company. Sold off a piece of its business called Peabody Coal because the antitrust laws kicked in, they were forced to sell it. And when they sold Peabody Coal, they got $600 million in cash from that sale. And it created an immediate problem for Kennecott. Kennecott was a $3 billion company, 600 million is 20% of the company's cash, and they were worried, they being the manager of the company. What do you think they were worried about, Scarlett? I thought having a lot of cash was good. Why might managers be worried about having a lot of cash? What were they worried about, do you think? Which is fine. So you share also, that is easy to fix, right? Just make sure it's invested in something safe and riskless. So you invest in cash in T-bills is always a safe way to go. If that were the problem, it's easy to fix. But what else does having a lot of cash do? They were worried about a hostile acquisition. You're saying, why would having a lot of cash on your balance sheet make you a better target for hostile acquisition? Because you made the acquirer's job a lot easier, right? Because when they buy your company, they can use your cash to pay for some of the proceeds. So you got 600 million in cash you don't have a need for. What's the most sensible way to get rid of this problem? Give it back to the shareholders, right? But what would they do? Stupid things like paying off their mortgages and paying for car expenses. No, you couldn't allow that. So they went for the second, that's the most sensible way. They went for the stupidest way to get rid of 600 million, which is spend it quickly. So they went to First Boston at that time, the leading M&A bank on Wall Street. And they said, we have 600 million cash. We want to spend the cash. Can you help us? What do you think the answer was? Of course we can. And a couple of weeks later, First Boston came back with the perfect target company. Perfect in what sense? You could buy for exactly 600 million, which works out to be coincidentally the cash you told me you had on your balance sheet. Rule number one, the value of a target company will magically expand to fill in whatever cash you have on your balance sheet. Now, do you see why Tim Cook never asked anybody, 250 billion in cash? Can you help me spend the cash? There will be a $250 billion company you're paying for. I'm going to show you the valuation they use because even banks have to have a fig leaf when they say you can pay 600 million, right? They have to show that what you're getting is worth more than 650 million. These are the cash flows that First Boston used to justify paying 600 million. I want you to focus on how the cash flows are estimated because I'm going to have a question to you at the end of what is the right discount rate to apply on these cash flows. So what First Boston did was it projected the revenues. It's the target company is a company called Carborundum. It's an abrasives company. Makes sandpaper, metallic abrasives. They projected the revenues, the expenses, came up with operating income, kept going, subtracted interest expenses to come up with net income. They added depreciation, subtracted capex, even debt repayments were paid off. And they came up with the cash flow. So I want you to think about what I did to get to the cash flow, because here comes the question. I'm going to give you 6 different discount rates I could use. Only one of them is the right one. Let's see if you can narrow down which of these 6 discount rates should be used to discount these cash flows. You got the acquiring company, which is Kennecott. You got the target company, which is Carborundum. You'll have a merged company afterwards, Kennecott, if you want to call that. Right? You can have the cost of equity for each of these companies and the cost of capital. So let's start easy. Given how I just estimated cash flows, should I be using a cost of equity or a cost of capital? And why would I use the cost of equity? Anybody? Go ahead, Diksha.
Because you made adjustments for debt repayment.
Because I computed cash flows out. One of the deadliest giveaways of what your cash flows are, if you start with net income, you probably dug yourself into a hole already because net income is after interest expenses and you're doing this right and you do debt payment. It's a cash flow equity. So that actually is good because we got rid of one column, right? So it's not the cost of capital, so that's because. Now comes to me the central question in M&A. And those of you who are planning to go into M&A, if you get this question wrong, please reconsider. Right? Anybody want to go into M&A? Okay, Adil, you'll be my M&A guinea pig, right? So we've decided cost of equity. Whose cost of equity? Acquiring company, target company, or merged company? Adil?
Target.
Target. Everybody agree with that? I'll play devil's advocate. Who's coming up with the money? The acquiring company, right? Why shouldn't I use my cost of equity? It's my shareholders' money. Why wouldn't I use them?
Because the cash flows I'm getting is the target company, so the risk should reflect the cash flow.
It goes back to a first principle in capital budgeting. The discount rate for a project should reflect the risk of the project, not the risk of the entity looking at the project. It's a lesson we forget very quickly because you have this stupid thing called a corporate hurdle rate. The minute you do that, you've lost your senses because you think the cost of capital is the cost of raising money. The cost of capital and valuation has nothing to do with you raising money. It's got everything to do with the rate of return you can earn on an equivalent investment. It's the target company's cost of equity, which in this case would have been 16.5%. Coven, what's the worst possible choice you could have made in here?
The cost of capital of
Bingo. That's exactly what First Boston used. They used the cost of capital of the acquiring firm using some stupid logic. First, mixing up equity and capital, right? Acting like they're into, and then this acquiring company argument. You're saying, what's the big deal? 10.5% versus 16.5%. Using a 10.5% cost of capital would have given you a value of about 750 million, which makes a 600 million perfectly reasonable, right? Taking their cash flows, I'm not even contesting a single cash flow. Using the right discount rate on it, you'd have ended up with $450 million. Now, what have you asked your client to do? Go pay 600 million for something that you actually have valued at 450 million. And for this, you get banking fees? I could have asked my doorman, what should I pay for this company? Probably got better advice. You're saying, how did this come out? Here's what happened. First, Boston thought it had done this right. It gave the numbers to a Harvard Business School professor, and every Harvard Business School becomes a strategy case. This became a strategy case about right fit and wrong fit. This was an exhibit. You're not even supposed to pay attention to it. This was the only thing in the entire case, to me, that I paid attention to, because the rest was dressing up a turkey. There's really nothing to do. This is Valuation 101. And guess who the co-heads for First Boston's M&A department were in the late 70s? Bruce Wasserstein and Joe Perella. Remember the Wasserstein-Perella? Because their punishment for this kind of malpractice was they created a boutique investment bank. God only knows what the boutique there means, pricing margins higher. And they did more of this valuation malpractice for 10 years. And the way they got punished for doing that was Dresdner Bank actually paid $2 billion to acquire Wasserstein-Perella for their valuation expertise. That's exactly how the president, I can't even make this stuff up. There's no justice in this world. But the lesson I want you to take away from this is not specifically about this particular case, but to think about when you see a name on the top of a valuation, Goldman Sachs, KKR, what do you assume? They must know what they're doing. Don't. I've seen valuation teams in practice. I know exactly why this happens. There's probably one team in one room working on the cash flows, another team in the other room working on the discount rate, and never the twain shall meet till 11:57 p.m. and midnight is your deadline, or midday is your 12 p.m. is your deadline. You got 3 minutes to bring it all together. Who's asking the big questions about what cash flows are you estimating, right? It happens far too frequently. So consistency in cash flows, we've come up the first step. We're going to add more consistency tests. Remember the consistency factor. So with that out of the way, let's go back and finish up that first intro packet, because we have a few other things to do. Any question though, because I want you to be ready with this, because half of all M&A valuations that I see use the wrong company's discount rate. And once you do that, the rest becomes moot. I don't care how well you estimate your cash flows. If you mismatch, you've lost the game already. Because if you mismatch, you know what's going to happen, right? You're a safe company. Use your cost of capital to value target companies. Tell me what you're going to end up doing, friends. If you're a safe company and you keep using your cost of capital value risky companies, it's not even that you're going to buy every risky company is going to look cheap to you. You're going to buy risk. Your mistakes are, you're saying, don't mistakes average out? Not if they're all in the one direction. Your mistakes are all going to be in the same direction. You're going to overpay for risky companies over and over again until you wipe yourself out. This is how AT&T almost destroyed itself as a company in the 1990s. Because it used its cost of capital, which was historically low, Marbell, to look at telecom company, which are technology companies coming up, say, that looks cheap, that looks cheap. And not once in this process did somebody ask, are we doing the right thing? So Any questions on acquiring target companies? Because we'll come back to this again in the context of valuing acquisitions. I left you with the 3 ways of attaching a number to an asset. I talked about discounted cash flow valuation and intrinsic valuation. You value an asset, put a number on an asset based on its cash flows, growth, and risk. Having said that, though, 90% of what you see out there is pricing. What is pricing? In pricing, you attach a number to an asset based on what other people are paying for similar assets. It's how we put a number on an apartment or a house when we buy it. No. In pricing, you remember in intrinsic valuation, you kept the faith like the Holy Grail. There is an intrinsic value. I'll never get to see it, but I'm going to keep trying. Here, you don't even try. So there's no such thing as intrinsic value. What somebody pays for something is all that matters. And if you break down pricing down, here are the things you will have as any pricing. First, it'd be nice if you could find something exactly like yours that is priced out there, right? And if you do, well, pricing becomes very simple. You just match up that price, that's what you pay. I can almost guarantee that's never going to be the case if you're valuing equities. In what universe are you going to find 15 companies just like Microsoft or Adobe or NVIDIA or any company? So what do? You gather together a group of companies that you claim are just like your company. I know you're lying, you know you're lying, but nobody pushes too hard. This is in every equity research. These are the 15 pure group companies. Then you recognize very quickly you can't compare price per share across companies. Why not? What's the most expensive company in the world if price per share were my metric of expensive or cheap? Berkshire Hathaway trades $350,000 a share. And a penny stock looks really cheap, right? But that makes no sense because price per share is arbitrary. I do a 2-for-1 stock split. NVIDIA did a 10-for-1 stock split. They're like a 90% discount on the price, but don't get too excited. It's also 90% discount on the earnings per share and everything or every other metric. So what do you need to do? You need to standardize the price. That's what a multiple is. Price earnings, EV to EBITDA. There's nothing magical about it using a standardized price. If you're in real estate, what's analogous? Price per square foot, because you can't compare 2 buildings of different sizes. And then if you're careful, and only if you're careful, you try to control for differences. Why? Because remember the 15 companies that you said were just like yours? You wake up and say, well, they're not just like mine. They have higher growth or lower risk, and you try to. This is the story of every pricing. Are you assuming market mistakes? Well, you are, but you're also assuming that markets are right on average. Do you see why? Because where are you getting the pricing for all those other companies? Across the market, you're saying markets are right across the 15 companies, but they make mistakes on individual companies. It's a very different perspective on market mistakes and comes with an advantage. Let's say you have a steel company trading at 5 times earnings, and every other steel company trades at 15 times earnings. It's going to stick out like a sore thumb, right? The mistake is going to be more visible. So what's more likely to happen? Remember the correction part? It's more likely to happen in a shorter time frame with pricing than with intrinsic valuation because the mistake is out there for everybody to see. So that's at the basis of pricing. Let's take a look at the advantages and disadvantages and who's best suited for pricing. Advantage pricing, you're always in sync with the market. What does that mean? You're never going to be out of stocks because everything is relative. 40 times earnings look high to you? But what if everything trades at 50 times earnings? It looks cheap. So on a pricing basis, there will always be cheap stocks. And that's good for people who have that as part of their mission statement. Let's say you're an equity fund manager at Fidelity. You don't have the luxury of saying everything is overvalued, I'm not buying it. You have to buy stocks. You're going to be using pricing because you have to buy stocks. You're a sell-side equity research analyst. What's your job? To take 15 companies and tell me which are buys and which are sells. That's a pricing mission right there. I don't have a problem with equity research analysts using multiples and comparables. I do have a problem with them playing kabuki dances with DCFs and claiming that their buy came out of a DCF or a sell. Let's stop this cover story. I mean, this is a pricing. So if your job requires you to always hold, you're going to essentially be in sync with the market. Right? It also does mean that you have a different game to play, right? You're trying not to gauge whether the market is right. You're trying to gauge something about the direction. So if you're a momentum-based trader, pricing is the only game you care about. And at least on the surface, pricing requires less information than valuation. Now, I've sent out that thing about capital IQ. If you get a chance, please get on, right? If you want to do a 5-minute pricing of NVIDIA, you can do it in 5 minutes. Just pull up a multiple for 20 semiconductor companies. I don't know how much you want to do with that pricing, but pricing doesn't require a whole lot of information. At least on the surface, it looks like you don't have to make the assumptions about cash flow and growth and risk that you do in intrinsic valuation. So those are the advantages. In fact, many equity research analysts, you ask them, why do you use multiples? Their answer is, because I don't like all these assumptions you have to make about cash flows, growth, and risk. So in fact, I heard from a few sell-side equity research analysts about my NVIDIA valuation. They said, all these assumptions you're making about the size of the AI market, the market share, the margins, I don't have to do any of that stuff. Really? Because here are the disadvantages of pricing. Do you really think you're not making assumptions about growth and cash flows and margins when you pay 50 times? I mean, NVIDIA, I think you're paying 4 times revenues or 6 times revenues for the company. Do you think Constantine, or do you think you're making assumptions about cash flows, growth, and risk when you pay 10 times revenues or 20 times revenues? First, on growth, are you assuming high growth or low growth? What kind of margins do you probably really high, right? Because so in a sense, you're making assumptions. They're just implicit. You see the advantage of implicit assumptions? People can't pick them apart. So when you do an intrinsic valuation, say, how do you know the AI market, chip market is going to be 300? I don't. I estimated it. Well, I didn't have to. You did it implicitly. I'd rather make it explicit and be wrong than implicitly make an assumption that I don't even know I'm making. So this notion that you're not making assumptions is a fraud. In fact, one of the things we're going to do when we talk about multiples, we're going to take each multiple and we're going to see what assumptions you're implicitly making when you pay 3 times book value or 5 times revenues or 800 times earnings. Second, let's be clear here. Now, whenever somebody who's pricing, and all of trading is built on pricing, talks dismissively about market efficiency, let's be clear that you're very selective about the market efficiency you dislike, because you just assume markets are efficient on average, that they make mistakes individually. At least be honest with yourself that you're assuming market inefficiency just like everybody else. It's a type of efficiency or inefficiency you're assuming. And finally, if you create a portfolio based on underpriced stocks, not undervalued stocks, is it possible that your entire portfolio could still crash and burn? So let's say you buy let's take a sector, AI sector. You buy underpriced AI stocks. God only knows what the metrics look like with these underpriced AI stocks. But remember, everything is relative to the average. So 10 times revenues is lower than 20 times, so you create. What's the risk you're exposed to? If the entire AI sector is overpriced, you could be right, and the way it'll show up is you lose only 60% of your portfolio, whereas everybody else loses 80%. If that's what gives you comfort, by all means, go that direction, but be at least aware of what you're getting. You're not getting undervalued companies, you're getting companies that are underpriced relative to something. So we talk about advantage, let's talk about who is best suited in doing. First, let's look at what kinds of assets are easiest to price. To price something, you need a large number of things, at least remotely like it, that are being traded, so they have a price on them. Now, do you see why when you have to get a number on fine art or a collectible, you have to end up giving 6 or 8% to an appraiser? I mean, if you have to price a Picasso, all you have to do is find hundreds of Picassos that got traded last year. Good luck with it. The last Picasso that might have been sold might have been 3 years ago. Pricing becomes much more difficult in some asset classes. It is because you don't have much in terms of transactions. And there has to be something in common you scale it up to. And this is the other problem. Let's say you did find 10 Picassos. What do you scale them to the size of the painting? I mean, that's not a very good measure, right? The Mona Lisa is tiny, but it's worth a lot. You know, your paintings that are huge that are not worth that much. I'm not even sure what the stand, and that's where the appraiser says, I know, I'm the expert. I can look at the brush strokes and tell you whether it's early Picasso or late Picasso. He could be lying, but you have no idea. You pay 8% of the price of the painting to Christie's or whoever else the auctioneer is. Pricing becomes easiest when you have low. That's why StubHub and SeatGeek work so incredibly well, right? And you want to buy tickets to a Taylor Swift concert. You're not sitting there agonizing over, am I comparing apples to apples? You are comparing apples to apples because they give you by section, these are the ticket prices. And they even give you, I think, a view of so you can check the view. So you can see why pricing works really well in some types of pricing. And what kinds of investors can turn pricing to their advantage? First, if your time horizon is shorter. Talked about how pricing corrects more quickly. So for a lot of investors, this seals the deal. You have a 3-month, 6-month time horizon, you're going to go with pricing. It's nice if you're judged against other people playing the same game. If you've seen Morningstar assign stars to mutual fund managers, you know how they assign the stars? What do? Alexander, what do you think Morningstar does to give you 5 stars or 3 stars as a mutual fund manager? And compare it to? They look at other portfolio managers who are so they basically have these 9 boxes that which are, people swim around the boxes all the time based on value or market cap. And you say, you're a small cap value mutual fund manager. These are what other small cap mutual fund managers did. And if they were down 15% and you're down 10%, you have 3 stars, 4 stars, even 5 stars. See what I mean by measured? You're not measured against an absolute. You're not measured against do you make money? You're measured against other people. And much of portfolio management is that dance. And here's what finally seals the deal. When you price things, you can find them underpriced or overpriced. If you're a Fidelity or a T. Rowe Price, it's only the underpriced that draw your attention. Why? Because as mutual funds, they're long only. They can only buy, they can't sell short. Wouldn't it be nice if you could if you're a good pricer, wouldn't it be nice if you could take advantage of both underpriced and overpriced? Because then you don't even have to be right about market direction. It's a correction towards what you think is. So who am I talking about, Bradley? Who can take advantage of both underpriced and overpriced?
Hedge funds.
If hedge funds actually behave like hedge funds. A lot of hedge funds dance a game. They really say, I'm a hedge fund, but look at them, all their positions are long only. You say, what makes you a hedge fund? But in theory, if you do this right, and so if you go to work for Citadel or Point 72, stop this nonsense about caring about discounted cash flow valuation. You're a trader. If you're good at pricing and you get convergence, you're going to make your money no matter what the market does. So if you look at the choices here and you look at what can I do, you're already going to see that depending on who you are and what you're attaching a number to, you might choose valuation sometimes and pricing other times. And as you do all of this, remember to value something, and I'm going to state the obvious, you need cash flows from that thing. So I can value equity, I can value a business, I can value a bond. So a few years ago, I wrote a piece on my blog, and I wanted to answer a question once and for all that I've been asked repeatedly since 2008, November. You know what the question was? Is Bitcoin under or overvalued? It drove me crazy. And finally said, you know what? I'm going to answer it for the ages. And from now on, whenever you ask me the question, I'm going to send you the link to this post. Okay? And I broke down investments into 4 groups. The first are assets. Assets generate cash flows. It can be a business, it can be a stock. No. The second are commodities. Is oil undervalued, overvalued? God only knows. Maybe I could build a macro model with demand and supply for oil. People try, but they fail miserably. It's priced based on demand and supply and mood. It's up today. Why? Not because there's less oil coming out of the ground, but because the fear of tariffs is driving the price of oil up. So oil is up for pricing reasons. Commodities can generally be priced. What about currencies? What is the dollar under or overvalued? I don't know. I can tell you what is under or overpriced. It's an exchange rate that reflects it. And today it's gone up because, again, it's a tariff drag. Maybe it's, it's a pricing judgment. And a collectible can only be priced. Any of you baseball card collectors? Beanie Baby collectors? My condolences. These are collectibles, right? What's the most famous and long-standing collectible of all? Gold. You go back thousands of years, people have held gold. In fact, I've been interested. Why did they pick that element out of all of the others? So what is it that made gold the choice? What are the things they look for, you think? What?
The inflation hedge.
No, that comes from it. They picked it. They weren't thinking inflation. It predates currencies. Remember that, right? People used gold before there were currencies. First is its physical qualities, right? You can melt gold. You can reform it. So it essentially outlasts other things, and that's why gold coins put in a pharaoh's tomb. You can go in 2,000 years later, it's still gold coin. So. And it's relatively scarce. You don't want to pick something which you can get all over the place. So has it held its collectible? Yeah, that's a good collectible. So you can answer the question, because I'm sure your friends, your relatives ask you about Bitcoin because you have an MBA and they assume you can tell them when to buy Bitcoin. What's the question you have to first ask about Bitcoin? It's definitely not an asset. Is it a commodity? Not really. Blockchain might lead to Ether, which might be a commodity, but Bitcoin is either a currency or a collectible. So to decide whether it's an under or overpriced currency, the question you have to ask is it a good currency? So let's step back again from the Bitcoin frenzy and think about what is it that makes a currency a good currency. Jessica, do you have any currency in your pocket today? See, but you have your Apple Pay, and presumably you've got digital currency in US dollars, right? Why do you carry around this currency?
It's just easier.
And what do you use it for? To buy things. Let's not forget that. One of the biggest reasons we have currency is we want to buy things, right? Buy lunch, pay for our Uber. So good currency is a medium of exchange. What's the other characteristic of good currency? So that goes to the first one, because they don't accept it, then it fails fundamentally. It has to hold its value, right? I'll give you my example of a good currency. I don't go to Switzerland that often. It's a little boring, but I don't. But when I do, and I remember about 6-7 years ago, I went to Switzerland. Then I used to carry currency. You to convert. Now I no longer do that. But at 100 Swiss francs, and I was leaving. I put it in my pocket, and I put it. I think I was wearing not jeans, but actually some dress pants, which I hardly ever wear. So I put it in my pocket. I forget about it. I don't even throw it in the wash. Disgusting, but I kind of hung it up. A year later, I pulled the pants down again. Occasion for dress pants again. I put my hands in my pocket and have 100 Swiss francs. Happened to be in Switzerland again. But you know what? Bought about the same things that it did a year ago, because it's a currency with almost no inflation. And it's also a currency that if I'd gone into a New York bank, I could have converted the 100 Swiss francs into US dollars, because it's a freely exchangeable currency. It's a good currency. Indian rupee? In India, acceptable for the most part, unless you had the wrong denomination in the wrong time. It tells you something about fiat currencies, right? They ride on what the government says is acceptable. But I still remember, I left India a long, long time ago, in 1979. I was in Mumbai airport. It's called Bombay Airport. That's how far long ago it was. It was a different name for it. I left, you go through immigration and you were in the international section. I went into a store and I wanted to buy something and they said they'd take only US dollars. I was still on Indian soil, but they said the line for using Indian rupees is done. You're now in US dollar territory. And if you fly to the US with thousands of rupees in your pocket and you try to pay for something, I don't think even if you walk into the Lexington Avenue Indian stores that they will take it. So it's a medium of exchange as long as you stay in India. And if I put 100 Indian rupees in my pocket and I forget about it for a year, odds are it'll buy about 5 or 6% less than it did a year ago. Not as good. It's in the continuum of currencies. Before you complain about the Indian rupee, thank God you don't have 1,000 Venezuelan bolivar in your pocket, right? First, is it a medium of exchange? Even in Venezuela, they probably say, do you have some lettuce instead of this? It'll hold its value a little better than the, yeah. So as a medium of exchange, it fails. And then as a store of value, God only knows, right? So even in fiat currencies, you can see you can be anywhere from the Swiss franc to the Venezuelan bolivar. So where in this continuum would you put Bitcoin? When was the last time anybody in this room used Bitcoin to pay for something? Nobody? You know how often I ask this question? You did, Julie? Were you working Silk Road or something? Something. Okay. Yeah. But I ask this question of people who are Bitcoin enthusiasts, people who say that Bitcoin is the next great thing. 1,000 people in the room. I never show up in person. I'm afraid of these people. I always say online only. And the question I ask is, how many people in this room? You'd be amazed at how few people who claim to be true believers in Bitcoin have actually used Bitcoin in a transaction. And there's a reason for that, right? Walk into a Starbucks. Let's say Starbucks decides to accept Bitcoin. Try to pay for a venti cappuccino with Bitcoin. Think about the process that gets started. First, remember, it's not a physical wallet and physical money, or not even like Apple Pay. There's a digital wallet where you supposedly have Bitcoin. That has to get magically transferred to the Starbucks digital wallet. And somebody's got to check whether both of you really are, one of you has the money and the other is receiving. So to get this transaction consummated, what has to happen? A Ukrainian miner, I'm not talking about a person doing it, but gets on a computer and tries to guess a 9-digit mathematical number. And if they get it right, you can get your cappuccino. If they don't, good luck with that. Comes up with a currency like that. That's an incredibly inefficient way to get transactions done. But you know why it's designed that way, right? You know, when Bitcoin came into being, paper written by Satoshi Nakamoto that pseudonym for that fat guy in Cleveland in a basement, I guess, nobody really knows. November of 2008. You're all too young to remember what November of 2008 looked like, but it was a scary time. We trusted no one, right? We'd lost trust in banks, in governments. It was born in a moment of paranoia. And I describe it as a currency created by the paranoid for the paranoid. If you trust no one, you got to run this 9-digit number. The reason you accept a $20 bill is because there is this trust built in, right? Even a $100 bill, that trust breaks down. You try to pay with a $100 bill in a store in New York, they won't take it. Why? Because if enough of that currency is counterfeit, they're not sure. Trust is the lubricant that allows us to get convenience, and Bitcoin is not a very good currency. The response always, but there are only 21 million units. Scarcity alone doesn't create a good currency. If scarcity alone determined, dog poop would be a currency too. There's only a limited amount of dog poop. And I know dogs keep creating more, but you can't use scarcity as the argument. This is why we're valuable. The fallback position, of course, is Bitcoin is a collectible. Yeah.
Remember to something you said earlier, why is gold a collectible and not a commodity?
Because what percentage of gold in the world do you think is held? I mean, it's used as a commodity in some things, as a commodity. And what percentage of gold do you think is held because people want to hold it as portion of their wealth? I mean, the answer is most of it is, and so it can play the role of commodity, and there are some things that gold is used for. Same thing with diamonds, right? They use diamonds for some sharp, but most of the diamonds we see are essentially diamonds being held because people think it'll hold its value. Yes.
Currency was backed by a commodity, like if I were to consider gold as a commodity, then the currency should be valued, right? Like we can value the currency.
You can price the currency against gold. You're talking about the gold standard? Yeah. So it was just, then gold became the base of currencies. It essentially kept currencies. It was a way of creating a good currency because what did governments do? They pre-committed. They said, look, what kills currencies is us printing more money. But because we can't print more money, it's a way in which it kind of built the trust. So let's take the other argument for Bitcoin, which is it's a millennial collectible. Why? Because you're 30 years old and you get scared. You don't want to buy gold because that's what your parents did. You buy Bitcoin. The question is it a good collectible? What makes for a good collectible? Let's take gold. It's staying power, right? It's a good collectible because it's always been a good collectible. You're saying don't collectibles that start off good always stay good? And I gave you the Beanie Baby example. There are people probably with their attics stuffed with Beanie Babies that they bought at the peak of that boom. We're saying, what the heck do I do with these damn things now? It's got staying power. And here's the second characteristic you look for a collectible. Why do people hold gold? Or some people, I don't hold gold, but there are people who are gold bugs who invest in gold. What is it that leads people to buy gold?
I think it's a safe haven.
It's a safe haven from what? So one is crises, but the second is that you no longer have faith in paper currency, right? If you lose faith in paper currency, you go to gold. It's always been true. That's why inflation, people go to gold. They say, I don't trust this paper you printed off because it seems to lose value. A good collectible holds its value when financial assets melt down. Go back through every crisis in history, and you'll see that gold, if it doesn't go up, at least holds its value. So in the first 3 months of 2020, during that COVID crisis, where the S&P 500 was down 33%, gold was up 2%. You're saying only 2%? Hey, come on, everybody else is losing 33%. Be happy that you're up 2%. Bitcoin, first, we can't check staying power yet. It's been around only 16 years, and it's tough to pass judgment on staying power. But I can check to see whether it's been a good collectible in terms of what it does during crisis. Remember those 3 months in 2020 when gold was up 2% and everything else was melting down, 33% down there? Does anybody remember what Bitcoin did during those 3 months?
Dang.
It was down 57%. When stocks came back by 35%, Bitcoin was up 60%. You see where this is going, right? Bitcoin, through its entire history, including today, has behaved like very risky stock. I'm not going to talk you out. I mean, you can claim that anything is a collectible, but so far at least, Bitcoin has been a terrible collectible. So if you're paying, what, 97,000 for Bitcoin, my question to you is, if it's a bad currency, it's an inefficient currency and a bad collectible, what are you paying 97,000 for? That's my problem with Bitcoin. It's not that I can't make an argument for cryptocurrencies or crypto collectibles. Remember those NFTs for a while that were taking off? Yeah. 30-second ad for something, you get the original ad. It's again a collectible argument. I'm willing to listen, but the question is, will it have staying power? Go ahead, Julian.
Theoretically, gold have to choose if like
It could.
It seems like you're looking to
With collectibles, there's no theory test, right? It's whether people buy into it. And for better or worse, when you've been around when you've outlasted every currency on the face of the earth. And the question is, could it happen? Yes. Tomorrow we could say this yellow thing is not that good. Let's switch to something else. That's what happened to shells, right? Shells were a currency on some islands until somebody probably landed with a whole bucket load of shells, and there goes the currency. Or people say this is not a great currency. So it's not, so collectibles and currencies can shift over time. But given its staying power, I have a lot more. But with fine art, this is often an issue, right? which is you pick a painter who's, selling for millions of dollars. Will that painting have staying power? That becomes the dividing rod in whether you're going to be good at making money on collectibles, is whether you pick those which have staying power. And if you do, odds are you're going to come out of the other end as a success. Now, we're going to do intrinsic valuation, we're going to do pricing, and along the way, somebody's going to say, well, what about the fact that you have, because I said there are only three ways. What about sum of the parts valuation? What about net asset value valuation? We'll be quite clear. There might be ways you approach valuation, but they're not approaches. And here's one. To do an asset-based valuation, where you take the balance sheet and you attach numbers to assets. Let's say your collection of real estate properties, right? Could I put a number on each real estate property? Yeah. But there are only two ways I can put a number. I can do an intrinsic valuation of the property based on rental income, or I can do a pricing of the property. Do you see where I'm going, right? Asset-based valuation is not a third approach. It's just a use of one of the first two approaches. When would you need it? Maybe you're trying to acquire a company because you want to break it up into pieces. Maybe you're a passive investor looking at a multi-business company, saying maybe it's undervalued and you want to value the pieces. So later in this class, we're going to talk about attaching numbers to multi-business companies by valuing the businesses individually, but it's not a separate approach valuation. It might also be something you need in a liquidation, right? Because in a liquidation, you're selling things off right now. And in fact, if you're doing liquidation, are you going to do an intrinsic valuation of the asset or a pricing of the asset? You have to do a pricing, right? You got to get whatever the market will get you. So in liquidation valuation, I don't want to see intrinsic valuations of assets. I want to see pricing of assets. So I'm going to ask this question to you now, but I'm going to ask you the same question at the end of the 15th week. So kind of giving you the big picture perspective of intrinsic valuation and pricing. If you had to pick based on what you know now, it might not be something you're saying, I don't know enough to make that judgment. Make your judgment based on what you know up to now. If you had to pick, would you pick intrinsic valuation or pricing? Are you entering this class with the presumption that markets are pretty good and they're mostly efficient, which is perfectly okay as well? Because when I come back to you on May 5th, the last day of class, and present this, you would have gone through 15 weeks of the class. And let's face it, that will change you. This morning in corporate finance, I said there are some semesters where I know right from the beginning that it's going to be a roller coaster ride. This semester feels like one of those. Last week was DeepSeek, this week is tariffs. What will next week bring? I don't know. But rather than view it as a problem, view it as an opportunity. This is going to be, as long as you don't have too much money being wasted, wasting away. It's going to be a rocky semester, right? And during that 15 weeks, you're going to be doing an intrinsic valuation of your company and your pricing, and maybe that experience will change what you think. And I'd be interested to see how many of you change your minds about your priors going in and what you get out of it. Just as a side story here, we're going to talk about applying option pricing in the context of valuation. Now, we know what makes an option an option. It's a leech. It derives its value from something else. So when you say something is an option, you know what my next question is going to be, right? What is the underlying asset? An option can't live on its own. It's got to draw its value from something. Second, the payoff is contingent on something happening. With a traditional call or put, it's the strike price, but there's a contingent payoff. And usually options have a limited life. Underlying asset, contingent payoff, limited life. But the best way to think about options is actually think in terms of payoff diagrams. If it looks even remotely familiar, you've probably seen this in your foundations class. What makes options unique is the fact that your losses are limited. You cannot lose more than what you paid for a call or a put. That to me is the insight I want you to keep in mind, because when you value an option, risk becomes your ally, unlike every other type of valuation approach. In discounted cash flow valuation, you raise risk, your discount rate goes up, your value goes down. In pricing, you raise the risk, you pay a lower multiple. But you get to an option and I raise the risk, you say, this is great. You say, so what is it about options? And the payoff diagram kind of gives you a clue that makes risk your ally rather than your enemy. Hector, what is it about options that makes risk your ally? I'll help you out. There are two types of risk, right? Downside risk and upside risk. Which one keeps you awake at night? And nobody lies because, oh my God, my stock could go up fivefold, right? That's not the risk you worry about. And what have I done with options? I've limited your downside risk. Risk is one-sided, right? So it's not some magic that happens, the payoff diagram that drives it. Now, there are actually listed options out there. Then we're not going to value them in this class because there's an option pricing class. If you are interested in valuing warrants and listed options and that you trade in the CBOE, it's a different place for that. In fact, even convertible bonds, in fact, much of fixed income is option pricing because you take a straight bond, you add callable features, convertible features, you can get that in your fixed income class. The kinds of options we're going to value here are actually valuations. I'm going to argue that equity in a deeply distressed company, it's a deeply distressed company, it's losing a ton of money, it's got a lot of debt. So what's hanging over your head? Bankruptcy, right? You buy equity in the company, you say, why would I buy it? You're buying it for the same reasons you buy deep part of the money options, which is you hope that something good will happen, then you pray that something good will happen. Most of the time, nothing good happens. But when something good happens, stock explodes because it's such a small slice of the company. Second, if you're an oil company and you have a lot of reserves that are not viable, I'm going to argue there's optionality there. We're going to apply options to value undeveloped reserves and how that plays out. If you're a pharmaceutical company or a technology company with a patent, an AI patent that's right now not viable, you might have something extremely valuable still because it's an option. Those are the kinds of options we're going to deal with. But it's a tool in my arsenal that I will not take out unless I absolutely have to. I'm terrified of people who pull this real options tool on every valuation that they do. It's like taking out a shotgun because you got an ant on your front on your front pathway. I think you might be overreacting here. And the advantage of using option pricing is you'll be able to attach numbers to things you otherwise give up on. Usually if you try to value money-losing company, distressed company, the problem you face is you try to do a DCF, you find that the value of the firm is actually less than the outstanding debt, and that might happen for some of your companies. You say, what do I do now? Intrinsic valuation, you're at dead end. So I'll drive pricing. Remember, there's no positive in you might be, none of the multiples work on you. Those companies, options can help you put a number on the company, right? And to me, the bigger thing is even if you never apply an option pricing model to put a number on an asset that has option characteristics, the insight about risk is what you take out of this. If you're going to buy equity in a deeply distressed company, for God's sakes, don't make it a deeply distressed, stable company. I'm not even sure what that means. I mean, basically, it's I lost 100 million last year. I can guarantee you I can lose 100 million every. That's not what you're looking for, right? You want movement because you got to get out of the hole. So if you're a vulture investor, which, you know, the class of investors in, you want the riskiest businesses to make these bets on, not the safest business. That's the kind of insight you want to get out of this. And finally, the disadvantages of option pricing is we have option pricing models out there. I'm sure you've seen, even if you don't remember the Black-Scholes model, came out in 1971. One of the, it's a clean model in terms of applying a number, but it was designed for short-term listed options on traded stocks. We're going to take those models and use them to value the class of options we talked about are called real options, which often are 10 or 15-year options on things that are not traded. I mean, you're pushing these models to the limits and perhaps even beyond of what you can use. So you're going to see pricing models kind of start to fray at the edges. Yeah. And there's always a risk of double counting. What does that mean? I've seen analysts value a company with a valuable patent, a drug patent that's working its way through the pipeline. They give the company a high growth rate because they think the patent will make it through the pipeline and come up with a value for the company. And then once they're done with the value, they'll pull out my book to the options chapter and value the patent as an option and add it on top of your discounted cash flow valuation. You've just double counted. If you want to count the option through your growth rate and cash flows, do so, or value it separately, but you can't do both. So there is a danger of double counting. But I think stepping back and keeping perspective of there are only three ways. Next time you see a valuation model, think of the bucket you're going to put it into, because that's a critical part of this process. So that's the intro. You can put it away now because I'm going to start in the first packet. If you didn't bring it, don't worry about it because not the end. Any questions on just the approaches to putting a number in something? If you can come up with some creative way of putting a number that I haven't thought about, let me know, and I'll think about which bucket to put it into. But trust me, if you think long enough, it's going to go in one of these three buckets. So what I'd like to talk about for the next 13 sessions is the basics of intrinsic valuation. So let's set the table. Okay? Discounted cash flow valuation, the intrinsic valuation, trying to value an asset based on its cash flows, growth, and risk. So when you talk about fundamentals and you truly mean it, that's what I hear. Okay? So for cash flow generating assets, the discounted cash flow valuation is a way of estimating it. It's not the only way, there might be others, but it's a way that we've developed and refined primarily in the last 100 years. But intrinsic valuation models predate the DCF, right? People came up with ways of bringing in cash flows, growth, and risk. So we shouldn't think we invented intrinsic valuation. It's always been around. So I'm going to show you the two most common forms of intrinsic value of discounted cash flow valuation. One of these you might have never seen before, but it's something that people use implicitly. The most common way in which you see discounted cash flow valuation, you take the expected cash flows. Keyword is expected. Across all scenarios is the expected cash flow. And you discount them back at a risk-adjusted discount rate. That's what the DCF I'm sure you've seen before. There's a second way of approaching discounted cash flow valuation that you almost never see, and you'll see in a moment why. Instead of using expected cash flows, use what I call certainty equivalent cash flows. Say, what the heck are certainty equivalent cash flows? Have you ever seen this game show called Let's Make a Deal with Howie Mandel? If you haven't, you should watch it. Here's how the game show goes. I'll go to a type of thing you'll see on the show. There'll be two suitcases up on the screen. One suitcase is $1 million, the other suitcase is nothing. You're a contestant. Say, come on down. So, Julian, you're going to be my contestant. Come on down. $1 million or nothing. You pick one suitcase. But I'm going to offer you cash to not even try. Okay, so don't think too long. This is not an intellectual exercise. It's an exercise. So what's the expected value of playing the game? 50% of $1 million, which is 500,000, right? So I'm going to start with 300,000. Would you take 300,000 guaranteed and walk away? 350,000, you see what this is going to depend. The more risk averse you are, the less money you take. And if you say, I'll take only 500,000, you're risk neutral. That's right. It's really, if you want to see risk aversion actually on the stage, I've never seen an episode where a contestant has gone all the way up to the expected value. I mean, their variants are how much lower. A certainty equivalent is like Howie Mandel playing games with you. So you want to value Coca-Cola, you do the expected cash flows in year one. Are those expected cash flows risky? Yes. So Howie Mandel says, what would you take as a certain cash flow? And you do this with year one, year two, year three. Howie's got to be at your beck and call. But when you're done, you now have certainty equivalent cash flows. And if you have certainty equivalent cash flows, what's the discount rate you should apply on them? The risk-free rate. Now do you see why nobody does this? Howie's not at your beck and call. And this becomes an exercise in hand waving. But implicitly, people do this. Whenever I hear the word conservative, and some of you are going to turn in valuations, I'm just being conservative. What are you doing? You're adjusting your cash flow below the expected value because you want to be conservative. Don't. And here's why. Because if you do that and then you use a risk-adjusted discount rate, you've double counted risk. One of the curses of teaching this class is Warren Buffett is out there saying things that people bring into this class. One of the things he's supposed to have said is that he doesn't like betas, we know that he uses a risk-free rate to discount cash flows. People come and say, Warren Buffett uses the risk-free rate. Why shouldn't I use the risk-free rate? Most famous value investor of all time. And I said, do you know what Warren Buffett is discounting with that risk-free rate? He uses a measure of cash flow called owner's earnings, which starts with net income, but counts only the net income that he thinks is countable. He doesn't want speculative net income. So already what's he doing? He's basically doing some kind of certain equivalent without Howie Mandel, saying this is my net income. Okay. He adds depreciation, subtracts capex, but basically he's starting with not a cash flow that's an expected cash flow, but his version of a certainty equivalent. If you want to play that game, by all means do so. But remember why you're using the risk-free rate. It's not because it's your required rate of return, but because you've adjusted the cash flow for your risk. That's discounted cash flow valuation. I'm going to use that as my vehicle to kind of put some propositions on the table that I think are obvious, but might as well be remembered. So when I posted last week on NVIDIA bulls have replaced Tesla bulls now as some of the most irrational people on the face of the earth. In fact, the minute you post an NVIDIA, you know it's coming. I got like 3,000 comments on it on different platforms. Most of them I don't read. But basically, they're one-trick ponies. Basically, there's and among the many insults they throw at me, well, none of which faze me, is they'll call me a theorist. You're a valuation theorist. And I have to laugh because I know how little theory there is in the class. You know what the theory of this class is? It's that equation right there. It's one equation. That's my entire class. The entire class is about coming up with better ways of estimating expected cash flows and better ways of adjusting my discount rate for risk. That's all of valuation, one equation. And it's an incredibly powerful equation that I can use to bring home a lot of big lessons about valuation. So I want somebody to be my guinea pig on this. Jessica, since you're in the first row, I'm going to make you my guinea pig. I'll make you look really good, don't worry. Right? So don't ignore all those other currency notes there. So empty envelope, sleeves are rolled up. I'm not a magician. I'm putting a $20 bill in the envelope. Ready for the first question? How much would you pay for this envelope?
How much would I pay? Up to $20.
I'm glad you said up to $20 and not $20 exactly, right? You saw me put it in. You know, most people just say $20. And if you pay $20 for an envelope with there's $20 in it, what do you walk away with? An envelope. Let's look at this crappy envelope. I've written so much on it. You know. First rule in valuation, if you know the value of something, always start your bidding at, I'm glad you said a lower number because people are confused, lower or higher. Maybe this is not the class for you, right? So you're in the right class. You said up, so you passed the first test. But this is an easy asset to value. If I put it up for auction, we're going to end up at roughly $20. So let's see where there. I'm going to try to get you to pay more. So I'm going to start adding stuff to this and let's see if it makes a difference. All these neat cards. I don't know which one to put in first. Let's start with this one first. What does it say?
Control.
Control. I'm adding control to the $20. The envelope was worth $20, but now I've added control to it. How much did you pay for this envelope now?
But control over what?
$90.
Control over, what does that mean?
Great question. And I wish more people ask this question, especially when their M&A bankers put a 20% control premium. This is like standard practice in M&A. In fact, I tried this with a group of Goldman Sachs M&A bankers. They were seasoned bankers back for a re-education camp. And one of them offered me 25. You know what I did? I sold him the envelope. He said, I didn't really mean it. I said, now that it's your own money, you feel the pain, right? Because you paid $5 for a 3x5 card that I stole from a stack upstairs. And I wrote the word control. You see where this is going next, right? Let's start adding more interesting stuff. And I'll leave the big things for later. What does it say?
Brand name.
Brand name, that's a big thing. Marketing, you're saying, this is amazing brand name, I'll add that. But it's a 3x5 card with the word brand name on it. Synergy, I can put that in there too. Magical. What? I'm sorry?
Can I cash it out for a Birkin?
I don't think so. What about AI? That's in there. I call these weapons of mass distraction. You know why? Because they show up after you've done evaluation. What about control? What about brand name? What about great management? And if you're really desperate, I'll add the word that I think will help you get over the, what does it say?
Right.
Strategic, most dangerous word in vendor business. You put it in there. Right? Weapons of mass distraction because they used to justify paying an extra amount. So I'm going to use that as my first problem. In fact, the last thing I was going to put was China, because until for the last 20 years, you put China into your story, there goes your value through the roof. I had to scratch it out and put India, because the China, and this is a problem with weapons of mass distraction. They can help you today, they can work against you tomorrow. Right? But they're thrown in there to justify paying more. Yeah.
Isn't also the assumption that all of these additional things like brand name, etc., like they're already part of the expected cash?
No, wait, we haven't even done it. So that's a different question. I'm going to create the first proposition, which is called the IT proposition. The two other things I had were two other currency notes. One is for 500 Indian rupees. And I was going to put it in an envelope and ask how much would somebody pay and hope they didn't check the year. It's a 2008 500 rupee note. It's just a piece of paper, not even very good toilet paper. Won't use it. The other is a $100 trillion note from the Bank of Zimbabwe. This is right before they changed the currency to something else, because when the inflation gets so high, you keep adding zeros. Yeah. But my point is that people throw these words because they want you to pay a premium and not ask why. So here's my first proposition. It's called the IT proposition. If it does not affect the cash flows and it does not affect risk, can we please stop talking about it? Let's go back to control, right? Julian, what's the value of control? The true value of control, not the 20% banker thing. What's the value of controlling a business? You run the business, right? And maybe you'll run it differently than the existing people running the company. You're already there. To value control, then I've got to value a business twice. Once with the existing management in place, once with you in place, and assuming you can do the right things, you'll get a higher value. That's the value of control. We're going to come back to this, but we've already established the foundations for when control is worth nothing. What kinds of companies is control worth nothing in?
When they have two classes.
When a company is already perfectly managed and perfectly run, right? What the heck are you going to change? Do you think there's a value of control in NVIDIA? I'd be struggling to find a value of control when you've taken a company that's increased its market cap by 3 trillion. And the CEO, at least until last Friday, was considered to be the greatest CEO to ever walk the face of the earth. That could change. So what's the value of synergy? Don't give me the 2 + 2 = 5 crap that sometimes gets fed out of classes. What's the essence of synergy? Two entities come together and they're able to do something that they could not have done as standalone entities. Is there? Yeah, you can have two companies come together, maybe in the same business. When they come together, they can cut costs because they couldn't have done it as standalone companies. A US consumer product company buys an Indian consumer product company, it opens up a new market, is able to grow in markets it couldn't grow before. That's synergy. We're going to value synergy, but it requires us to be explicit about not just synergy as a word, but what does it mean? We'll come back and talk about brand name, and those of you in marketing are welcome to take issue with it. But if you truly have a brand name, it should show up in your pricing power, your margins, and your cash flows. In fact, we're going to value Birkenstock, a company that's all intangibles. Great management, brand name, celebrities love it, and Barbie wore it in the movies. It pushed up the revenues 30% that summer, and we're going to value each piece. My point is that it's not that these words don't have value, but if you do your intrinsic valuation correctly, they should already be in there. It's a sloppy way of adding things afterwards because you forgot to deal with them first. Yes, Scott.
I was just curious, when you talk about like the India or China premium,
Yeah.
Are you assuming that it's no longer going to impact cash flows because you've already?
No,
accounted
it's
for it
because
in
you were
your
too
growth?
lazy to bring in the cash flows. You just wanted to pay the premium first and hope the big market takes care of your mistake. This is why weapons of mass distraction are so dangerous, is because you let the word drive what you pay. And then you say, oh, there's a big market out there. I'll figure out a way to cover what I paid. And by then it's too late. It's exactly my problem with AI. Is AI going to be a big market? I believe so. But does that mean I'm going to pay tens of billions of dollars for you because you're an AI company? Not so fast, right? That's what intrinsic valuation for. It's not saying that India is not a big market to be in, but says, let's be more explicit about what exactly you're going to do there that's going to create the cash flows. Right? The follow-up to that is what I call a don't be a wuss proposition. And many of you, I want you to remember this because 2 or 3 weeks into the class, you're going to say, so uncertain. I want to go pick a nicer company to value. You're all going to end up at Kraft Heinz and Coca-Cola because, hey, don't be a wuss. There's uncertainty. Guess what? Everybody valuing this company faces uncertainty. So right now you say, I don't feel like valuing NVIDIA with this DeepSeek thing on. Nobody feels like valuing NVIDIA right now. Fight through that because all of you will face it as you value companies. How the heck do I know what's going to happen? Nobody does. Make your best estimate. The third proposition is what I call the DER proposition. It's named after my daughter, who's now 30, but this was when she was 15, 16, still at home. Used to have family dinners, and I had the singular misfortune of sitting across the dinner table from her. And a topic of conversation would come up where I thought I had something valuable to add to the conversation. I'd open my mouth, and she'd look across and say, Dad, duh. The amount of contempt that oozed out of it was so much that I stopped talking for like 2 years, I think. She kind of has gone past that phase now. She actually talks to me and she doesn't. But the DER proposition is reserved for a special subset of questions I get on valuation. And here's how the questions will go. I'm valuing a money-losing company. I expect it to lose money forever. What valuation model do you think will work best on this company? You feel like slapping the person around the face saying, wake up. You have a money-losing company. You expect to lose money forever. They should be paying you, not the other way around. What happened after the German reunification of the Treuhandstaat, the East German companies that thought they could sell, they actually had to end up paying the West German companies to take them off their hands. So if you're valuing a company which has negative cash flows as far as the eye can, don't intellectualize this question. See, what kind of company would that be? A company with a broken business model with no way out. Company like MoviePass. Did any of you guys subscribe to MoviePass when it was a business? Rand, do you remember MoviePass?
Actually did a project on movie.
So tell me how it worked. What did you have? What did the subscription look like?
Paid $20 or something.
No, $9.99, and you could watch as many movies as you wanted in any theater you wanted, and MoviePass would pay at the theater. And I remember looking and saying, how the hell do you get away with this business model? I mean, how much does a movie ticket cost in New York City now? $20. $9.99, you can watch 10 movies. Everyone's like, who would be stupid enough to come up with a business model like this one? And then I got the answer. The CEO of the company came on CNBC and said, I see how somebody can be stupid enough to come. Because here's how he justified the model. He said, the average American goes to one movie a month. The average movie ticket in America costs $7.50. We're making $2.49 for the average American. This is a great business model. What's wrong with this logic? The average American is not subscribing to MoviePass. It is. And so it's people like my son. You know how many movies he went to last month? 23 movies. He waits till his 2 little kids are off to on sleep and he goes and watches a movie. He works at Disney, he claims this is work for him. He has to get the competition nailed down. But he was a MoviePass subscriber. And I said, Ryan, single-handedly, you're driving the company into bankruptcy. But here's the scary thought. The company lasted like 4 years, burned through $2 billion of venture capital cash. And I want to get my hands on the list of people who invest in this company because these people should not be allowed to invest in a business ever again. Which brings me to the final proposition, which is the don't freak out proposition. Some of you are going to pick a company, going to estimate cash flows for next year. It's going to be negative. Year 2, you're going to be negative. And you say, oh my God, this is MoviePass again. Don't give up so easily. There are companies which can have negative cash flows upfront, which can still be valuable companies because the cash flow, as long as the cash flows later in the process are positive and disproportionately positive. Do you see why disproportionately positive? Because you lose $1 billion in year one, you got to make $5 billion in year 10 to make up for it. What kinds of companies are we talking about here? Negative cash flows upfront. Any young company, because if you take a mature pharmaceutical company, this is not going to be a young pharmaceutical company, young technology company, young infrastructure company. Don't give up too quickly. So the next 3 pages you already saw as part of which is when you sit down to value company, you're going to have to make choices. Are you valuing the equity in the company, in which case you focus on cash flows to equity and discount cost of equity? Or you're discounting valuing the entire firm, or you take the cash flows, which are pre-debt cash flows, and discount them back at the cost of capital. So on Wednesday, when we start, I'm going to talk about this process of because basically there are 2 ways you can attach a value to equity, right? You can take cash flows to equity, discount the cost of equity, or you can value the entire firm and arrive at the value of equity, which is what we tend to do in a lot of. Should you get the same answer? And if you don't get the same answer, what could cause it? That's going to be the question we start with on Wednesday. But we set the table. So Wednesday, we're going to dive into actually starting to estimate risk-free rates and risk premiums. You're saying estimate risk-free rates? In some currencies, it's an estimation process. There's no given number. So I'll see you on Wednesday. Yeah. How are you?
One question. I really didn't understand how a commodity.
Commodity actually gets used to the there is a use thing. Collectibles
It's like a baseball card.
Exactly, right?
So community value because there's supply.
There's a demand for oil, there's a supply for oil. So you try, you might be able to value those things. How much oil is being produced per down, how much oil do you know, oil is actually.
Right, so you can value it because that oil, something status.
So you can start, it's very difficult to do. That's why most people give up and they try to. But it can be done.
Thank you.
Yeah.
Questions are clear. Early stage.